Welcome back to Fast Money. Wall Street rocked today as we continue to follow the latest developments out of Chinese property giant Evergrande, the company on the brink of collapse, sending shockwaves through global markets. Let's get to Eunice Yoon on the ground in Beijing with more.
Evergrande is China's second largest property developer. The company owes $300 billion in liabilities and recently warned it sees significant decline in property sales and cross-default risks. We'll soon find out if Evergrande will avoid default. 4 things to watch. First, interest payment deadlines on bank loans and bonds this week. If Evergrande fails to settle payments on bonds due Thursday within 30 days, it could face restructuring. Second, a rescue plan. Beijing has signaled it's not keen to step in with a direct government bailout and potentially encourage excessive borrowing in the private sector. Chinese media are now reporting one of its rivals, Country Garden, might buy assets. Third, central bank action. The expectation is the People's Bank of China will inject liquidity to avoid a credit freeze. Evergrande is representative of a highly leveraged sector, and the fear is the company could trigger a wave of defaults. And finally, the market resumes Wednesday after a long public holiday. So we'll get a picture midweek of how investors here in China react. Back to you.
Thank you, Eunice. For more on Evergrande's debt issue, let's bring in Chris White of BondCliq. Chris, great to have you with us. How do you think about the possible impact of a default?
Well, I think one of the things that we're seeing right now is we're seeing an example of what the Fed and many of the G7 countries have been trying to avoid, which is a super large issuer actually defaulting and what that might do to the overall confidence in the market. So as you were just talking about what the Chinese central bank might do, it's very, very important to watch their action here, because if they decide to have a hands-off approach, it could start to shake confidence in dollar-denominated emerging market debt, which has been hot for the past 3 or 4 years as global investors have been looking for yield.
So who owns this debt in large part, Chris? I mean, I imagine lots and lots of funds do. As you mentioned, there are so many funds out there, so many investors are starved for any kind of yield.
Yeah, there are going to be some names in terms of the big holders, people that you know. I know BlackRock's in the top 5 in terms of one of the holders. That's looking across all of their corporate debt, specifically around the 2 issues that are trading in the marketplace. The holding information is public, but I think what's going to be important here is not just who the holders are, but really how is the treatment of a default going to be different than what the G7 countries have done? Because if the treatment is really what we used to do in the old days, which is just let an actual company default, I think that's when a lot of people will be questioning the strategy of having invested a lot of dollars into dollar-denominated emerging market debt, because the central banks may not bail them out like they have in the G7.
Chris, it's Karen. Thanks for being on now. I've looked at the debt over the last couple of weeks, and I mean, this is not a surprise to the debt. I know it was down a lot yesterday, but it's down a ton. Doesn't it already reflect default or really very low likelihood of getting anything remotely close to par back? Hasn't most of the pain been felt?
Well, absolutely. If you were a holder a month ago, bonds were trading, for example, in their issue that's maturing in about 6 months, bonds were trading at 53 cents on the dollar. Those bonds we're seeing on our system now, where trades are being reported at about 25 cents on the dollar. So you certainly felt the pain on that ride down. And that should be incredibly concerning with something that's going to mature in 6 months, because most people assume that within 1 year that the probability of default, even in some of the most distressed issues, is next to 0. But the thing that's happened that's really quite concerning is that the moves have been codified with a big increase in overall trading volume, which to me is the market affirming that there's a real problem here. And the more you see the prices go down, the more people are basically pricing in the fact that the Central Bank of China is not going to step in.
Chris, if we sort of go one step further with this in terms of your extrapolations, if we are to believe that investors will think differently about dollar-denominated emerging market debt, could they then pull their money out of other issues and put it into other corporate debt? I mean, I'm just trying to think of how investors, if that really is the impact in terms of how investors regard the quote-unquote safety or backstop of this sort of debt, assuming that central banks will step in and central banks do not step in, then what happens?
Yeah, I think you're making a really clear point. Like, what would you look for to understand whether there's a bigger problem with global markets beyond this default? And I think that if large investors do lose faith in dollar-denominated emerging market debt, what you will see is global debt markets will have a larger number of issues that are negative yielding. I think the total outstanding volume or outstanding size of negative yielding debt was about 12 trillion. That's down from 18 trillion about a year ago. And I could see that number going up to 20, 25 trillion because it ends up becoming a flight to quality, and that pushes all of the yields down and all of the prices up for debt. So, the emerging market, dollar-denominated emerging market market itself has about tripled in the past 6 or 7 years. And that just shows you how much appetite there has been for yield. You shut that market off, people are going to have to put their money somewhere, and you're going to see it come back to a lot of these G7 nations and start to form some ultra low interest rates.
Chris, thanks for joining us. Appreciate it.
My pleasure.
Chris White, BondCliq. Tim Seymour, these are obviously extrapolations, sort of, out there on the spectrum in terms of what can happen. But how should we think about emerging market debt when so many investors piled in such a low yield world?
Well, I think EM debt, dollar-denominated EM debt, that in most cases is high yield. Although outside of the sovereign level, there's plenty of investment-grade credits. I mean, let's not confuse. And Chris, by the way, he's great. I mean, every time we have him on our show, I think our viewers learn a lot more about how credit markets work. But there's a difference between negative yielding bonds as a function, really, of where inflation is and where yields are. Real rates versus actual rates. In terms of credit quality, look, every central bank in the world has forced investors out the risk curve. And it's a case where at some point, again, think about where we were relative to pre-COVID levels. We're about 50% tighter on the average across high yield debt. And it's not sustainable in a world that's slowing down from a growth perspective. So I don't think EM debt as an asset class. I realize China is a bright light on EM dollar-denominated debt. But it's been like this for a long time. I think a lot of EM countries, first of all, have very, very liquid local currency bond markets, and they use their local currency as something that can float freely and actually remove a lot of pressure sometimes in these situations. They have a lot more local currency debt than they used to. But there's no question. Big investors, and the reason you hear about BlackRock, a lot of that is just that they have some of the biggest ETFs in emerging. So that's what they do. They hold this debt. And in some sense, they're the most sophisticated investors in the space. So I think we have to think about this in the context of just it's a wake-up call for what central banks have done to every investor, especially public pension funds and endowments who have had to reach out for riskier debt and in many cases really don't know what they own.